Goldman Sachs has been lying to you. Not the polite kind of lying where they shade the truth or hedge their language. Not the Wall Street version of lying where they say, we maintain a neutral outlook, while their trading desk bets the opposite direction. No, I'm talking about a calculated, deliberate institutional deception designed to keep you, the retail investor, on the wrong side of the greatest trade of the decade. For months, Goldman's public-facing analysts have told CNBC, Bloomberg, and every financial outlet that would listen that silver is fairly valued in the low 30s. They published research notes calling precious metals overextended. They told their retail brokerage clients to rotate into AI stocks and treasury bonds. But while their public analysts were telling you to sell, something very different was happening inside the building. Something that was never meant to leave the internal research portal. Something that puts a price target on silver that would make most retail investors choke on their morning coffee. $150. That is the number buried inside Goldman Sachs' internal commodities model. And today, I'm going to show you exactly how that number was derived, why they buried it, and what it means for every single ounce of silver you own. I am your host, this is the Market Cipher, and what you are about to hear changes everything. Before I show you the model, you need to understand how Wall Street research actually works. Because if you think the research note that lands in your brokerage account is the same analysis that the partners at Goldman use to allocate the firm's own capital, you are living in a fantasy. Wall Street operates on a two-tier information system. The first tier is public research. These are the reports published by the sell-side analysts. They have price targets, they have buy, sell, hold ratings. They are written in careful, compliance-approved language designed to generate trading commissions from retail clients. They are marketing documents dressed up as analysis. The second tier is internal research. These are the proprietary models used by the firm's own trading desks, their principal investment group, and their strategic advisory clients. These models are not published. They are not shared with outsiders. They are protected by information barriers that would make the Pentagon jealous. The public target for silver from Goldman's commodity desk has been hovering around $36 to $41. Mildly bullish, nothing exciting, nothing that would make you back up the truck. But recently, a document began circulating in certain institutional circles, a leaked internal commodities scenario analysis from Goldman's Global Investment Research Division. The document runs 4 scenarios for silver over the next 18 months. Base case, bull case, bear case, and what they call the supply disruption case. The base case is $48. The bull case is $79. The bear case is $28. In the supply disruption case, the scenario they assigned a 35% probability. Not a fringe scenario, not a tail risk, but a 1 in 3 chance, has a 12-month target of $150 per ounce. $150 from the same firm telling retail clients to hold at 35. Now your first question should be why? Why would Goldman publish a $38 target externally while their internal model says 150 is a 1 in 3 probability? Is it incompetence? No. Goldman does not hire incompetent people. Their quant team is arguably the best on the street. Is it a different methodology? No. The internal model uses the same data inputs as the public model. Same mine supply figures, same industrial demand projections, same comex inventory data. The difference is one variable. One single input that the public model ignores and the internal model includes. That variable is unallocated central bank demand. The public model assumes central bank silver purchases continue at their historical average, roughly 30 to 40 million ounces per year globally. That is the number the World Silver Survey reports. It is the polite, official, on-the-record number. The internal model includes a shadow estimate for unreported central bank accumulation, routed through sovereign wealth funds, state-owned enterprises, and intermediary bullion banks. Goldman's own intelligence suggests this real number is north of 120 million ounces per year and accelerating. That single adjustment, swapping the official demand number for the real demand number, changes the entire output of the model. It turns a $38 target into a $150 target. One variable, one lie of omission, and a 300% difference in the price. Let me walk you through the math, because the math is where the lie falls apart. Global silver mine supply last year was approximately 820 million ounces. That number has been flat to declining for 6 consecutive years because nobody has built a major new silver mine since 2016. The permitting alone takes a decade. The supply is geologically constrained, and it is not coming back. Now let us look at demand. Industrial demand, which includes solar panels, electric vehicles, 5G infrastructure, semiconductors, and medical devices, consumed approximately 680 million ounces. That is a record. And it is growing at 8 to 11% annually because of the global energy transition. This demand is not optional. It is structural. Investment demand, coins, bars, and ETF inflows took another 260 million ounces. Add those together. 680 plus 260 is 940 million ounces of demand against 820 million ounces of supply. That is a structural deficit of 120 million ounces using the official numbers alone. Now here is where Goldman's internal model diverges from everything you have been told. If you add the unreported central bank accumulation of 120 million ounces, the real deficit is not 120 million. It is 240 million ounces. That is nearly 30% of total mine supply that simply does not exist. In commodity markets, a deficit of 5% is considered significant. A deficit of 10% triggers supply panic and hoarding behavior. We are staring at a deficit of 29%, and the price is sitting at levels that suggest perfect equilibrium. The price is lying. The model then applies a price elasticity function. At what price does demand destruction begin to close the gap? At what price do industrial users start substituting away from silver? Goldman's internal estimate is that meaningful demand destruction does not begin until $95 per ounce because there is no viable substitute for silver in photovoltaic cells or high-frequency electronics. The physics will not allow it. The chemistry will not allow it. So the model iterates upward. It raises the price until supply and demand reach equilibrium. And the clearing price, the price where the deficit closes to zero, is $147. Goldman rounded it to 150, but the model actually understates the problem because it assumes that above-ground inventories can bridge the gap while prices adjust. And that assumption is collapsing in real time right before our eyes. Comex registered inventory, the silver that is actually available for delivery against futures contracts, has fallen by over 60% in the last 2 years. We track this data on this channel. The drain is accelerating, not slowing. The LBMA, London's vault system that backstops the global wholesale market, reported a drawdown of 120 million ounces over the past 18 months. The metal is physically leaving the Western financial system. Where is it going? East, Shanghai, Mumbai, the Gulf states. It is being absorbed by economies that are building permanent physical reserves and have no intention of leasing it back into the paper market. That metal is gone. This is the critical point that Goldman's public analysts conveniently ignore in every television appearance. You can have a deficit on paper and still suppress the price, as long as existing inventories are available to fill the gap. But when the inventories run dry, when the buffer stock is depleted, the price does not adjust gradually, it gaps. It does not walk politely from 35 to 150 in an orderly fashion. Over 12 months, it trades at 35 on a Friday and opens at 80 on a Monday, because the last available inventory was swept over the weekend by a sovereign buyer who does not care about the paper price. That is how commodity shortages resolve throughout history, not with a gentle curve, but with a cliff. Goldman knows this. It is explicitly modeled in their supply disruption scenario. They call it a nonlinear price adjustment event. In plain English, that means the price explodes overnight, and there's nothing any institution on earth can do to stop it. So why does the public target stay at $38? Why does the Goldman analyst who goes on Bloomberg smile politely and say, silver is interesting but not compelling at current levels? Because Goldman Sachs is not a research firm, it is a trading firm. And the research exists to serve the trades, not the other way around. This is the part they do not teach you in any business school. When a major investment bank publishes a low price target on a commodity, it is secretly accumulating. That low target serves a very specific function. It keeps retail money out of the trade. It keeps the price suppressed long enough for the firm's proprietary desk to build its position at artificially cheap levels. This is not theory. This is documented history. It is a hunting technique. The public research is the bait. The internal model is the map to the real treasure. And retail investors are the ones left holding the decoy. Think about it logically. If Goldman genuinely believed silver was heading to 150, would they publish that number on the front page of their research portal and let every retail investor, every hedge fund, and every sovereign wealth fund on earth front run them? Would they announce to the world that they have found the most undervalued asset on the planet? Of course not. They would accumulate quietly, suppress the narrative publicly, and reveal their position only after they have finished building it. And we have evidence that this is exactly what is happening right now. CFTC, Commitment of Traders. Data shows that the commercial category, which includes the bullion bank trading desks, has been reducing its net short position for 14 consecutive reporting periods. They are covering their shorts. They are getting out of the way. Some of them, based on the swap dealer subcategory, appear to be flipping net long for the first time in years. Meanwhile, their public-facing analysts are telling you to sell. The left hand says sell. The right hand is buying everything the left hand shakes loose. This is not a conspiracy theory. This is the documented, reportable, auditable reality of how Wall Street has always operated. And it is happening right now, today, in the silver market. The mainstream financial media will not cover this story. They will not connect these dots for you because the banks are their advertisers, their sources, and the reason those television anchors have jobs. You will not hear this analysis on CNBC. You will hear it here on the market Cipher, because this channel exists to decode exactly these kinds of asymmetries. Now, let me tell you why this matters beyond your portfolio. Because if Goldman's internal model is correct, and a 35% probability is not a fringe case, the consequences ripple outward through the entire global financial system. Every bullion bank that is still holding a significant net short position in silver futures is sitting on a ticking financial bomb. The total comex short interest currently represents over 800 million notional ounces. Most of those contracts were sold at prices between $24 and $40. If silver reprices to $150, the aggregate mark-to-market loss on those positions exceeds $80 billion. That is not a rounding error on a quarterly earnings report. That is a solvency event for multiple systemically important financial institutions simultaneously. The clearinghouse will issue margin calls that some of these banks simply cannot meet with existing liquid reserves. They will be forced to sell other assets, treasuries, equities, corporate bonds, to raise emergency cash, and that forced selling will crash other markets. The contagion will spread from a single commodity to the entire financial ecosystem within hours. This is the reflexive doom loop that keeps Federal Reserve officials awake at 3 in the morning. A disorderly silver repricing does not just hurt the silver shorts, it destabilizes the collateral chains that support the entire $600 trillion global derivatives complex. Goldman knows this because Goldman modeled it. The internal document reportedly includes a contagion appendix attached to their supply disruption scenario. Their estimate is that a disorderly silver repricing event could trigger between $200 and $400 billion in collateral calls across the entire G-SIB banking system within 72 hours. This is why the $150 target stays buried inside the building. Publishing that number does not just move a commodity price. It lights a fuse under the banking system that Goldman itself is a structural part of. They are trapped between their fiduciary obligation to their trading desk, which says buy every ounce of silver you can find, and their systemic obligation to the banking establishment, which says keep the price suppressed at all costs to prevent a chain reaction. Right now, the establishment is winning that internal argument, but the math is patient. And the math always wins in the end. And here is the part that should terrify every central banker on the planet. The Federal Reserve's response to a silver-driven banking crisis will be identical to their response to every crisis since 2008. Print money, provide emergency liquidity, backstop the losses, socialize the risk. But printing money to solve a crisis caused by a physical commodity shortage is like drinking salt water to cure dehydration. The more dollars you print, the more the currency devalues against real assets. The more the currency devalues, the higher silver goes in dollar terms. The higher silver goes, the larger the bank losses become. The larger the losses, the more you have to print. It is a self-reinforcing death spiral with no mathematical exit. The only way to break the loop is to let the insolvent banks fail. And the Federal Reserve has demonstrated in 2008 and 2020, and in every crisis in between, that they will never, ever make that choice. They will sacrifice the purchasing power of every dollar in your savings account before they sacrifice a single too-big-to-fail balance sheet. Goldman's internal model captures this dynamic in what they call the monetary feedback multiplier. For every dollar the Fed injects into the system to stabilize a commodity-driven liquidity crisis, silver's fair value increases because the injection itself is inflationary. Run that multiplier against a multi-trillion-dollar intervention, and you get a silver price that makes 150 look like the conservative floor, not the ceiling. This is why the supply disruption scenario is not the extreme case. It is the starting point. In a true monetary crisis, in a scenario where the Fed is forced into another round of quantitative easing to save the banking system from a commodity squeeze, the model output goes parabolic. The price target becomes theoretically unbounded because you are dividing a finite physical element by a currency that can be created in infinite quantities with a keystroke. Goldman's quants understand this. The model reportedly carries a footnote on the supply disruption page that reads, and I am paraphrasing from the circulating summary, price targets above 150 are theoretically unbounded under sustained monetary expansion. Theoretically unbounded. That is Goldman Sachs, the most sophisticated financial institution in history, telling their internal clients that silver has no ceiling if the printing press gets turned back on. And the geopolitical environment is accelerating every single one of these dynamics. China has been importing record quantities of silver through Hong Kong and the Shanghai Gold Exchange. The Shanghai premium over London spot has averaged $3 to $5 per ounce for the last 6 months. That persistent premium is not a glitch. It is the physical market screaming that Eastern buyers are willing to overpay because they cannot secure enough metal through normal Western channels. Russia quietly added silver to its official strategic reserves classification this year. India's silver imports have more than doubled year over year. The BRICS nations collectively are assembling the raw material foundation for a commodity-backed monetary alternative, and silver is one of the foundational elements. These nations are not buying silver to trade it for a quick profit. They are buying it to hold it, permanently, strategically. Every ounce that moves from a London vault to a Shanghai vault is an ounce that will never return to the comex delivery system. It is gone from the Western paper market forever. Goldman's model accounts for this Eastern accumulation. Their unreported central bank demand estimate is built primarily on satellite imagery of refinery throughput in China and India, combined with shipping manifests tracked by their commodity intelligence unit. They can see the metal moving even when the governments refuse to officially report the purchases. The geopolitical bid underneath silver is structural, not cyclical. It will not reverse with a trade deal or a diplomatic handshake at the G20. It will only accelerate as de-dollarization deepens, and as nations realize that holding physical commodities is safer than holding the IOUs of a country running $2 trillion annual deficits. Goldman knows this. It is baked into their model. And it is precisely why their internal forecast is 4 times higher than the number they show you on television. So, what do you do with this information? How do you position yourself when you now know that one of the most powerful financial institutions on earth has a private model that says silver is worth 4 times its current price? First, understand the timeline. Goldman's supply disruption scenario operates on a 12-month horizon. That means the $150 target is not a retirement thesis. It is not a someday fantasy. It is a window that is already open and narrowing by the week. Second, understand the vehicle. Physical silver in your direct possession is the only form of this asset that cannot be diluted, defaulted on, rehypothecated, or confiscated through a brokerage failure. Paper claims on silver, whether ETFs, futures contracts, or unallocated accounts, carry counterparty risk. In a systemic crisis, counterparty risk becomes counterparty certainty. If you can hold it, hold the metal. Third, watch the comex registered inventory reports. When that number drops below 30 million ounces, we are in the red zone. The delivery mechanism will be on the verge of failure, and the non-linear repricing event that Goldman modeled moves from probability to inevitability. We track this data every single week on the market Cipher. Subscribe and turn on notifications if you have not already. Fourth, do not let short-term volatility shake you out of a generational position. If silver drops $3 on a random Wednesday and CNBC runs the breathless headline, "Silver Rally Loses Steam," understand that you now possess information that their analysts either do not have or will not share with you. The model has not changed, the deficit has not changed, the central bank accumulation has not changed. A $3 dip in a market heading to 150 is noise. Train yourself to treat it as noise. Fifth, recognize that the window to accumulate at these prices is actively closing. When institutional capital begins to front-run the supply disruption scenario, and it will because this document is circulating through every macro desk on Wall Street right now, the price will move faster than retail can react. The time to build your position is before the crowd arrives and tramples everything in its path, not after. I am not a licensed financial advisor. I'm not telling you to bet money you cannot afford to lose. But I'm telling you that Goldman Sachs, the most sophisticated trading operation in the history of modern capitalism, has built a model that says silver at today's price represents a generational mispricing of historic proportions. You can ignore that, or you can act on it. The choice, as it always is, remains yours. But at least now you are making that choice with the same information the insiders have been using. Let me leave you with this final thought. For decades, the precious metals market has been a rigged casino where the house had access to cards that the players could never see. The banks had the models. They had the real data. They had the internal research. And retail investors were playing blind, making decisions based on the same sanitized public price targets that were specifically engineered to keep them on the losing side of the trade. That information asymmetry is fracturing. It is breaking apart in real time. Communities like this one are doing the work that the compromised sell-side analysts refuse to do. We are connecting the comex data to the LBMA data, to the Shanghai premiums, to the shipping manifests, to the CFTC reports, and the picture that emerges is identical to what Goldman sees on their internal screens. Silver is catastrophically underpriced relative to the physical reality of its supply, its demand, and the monetary debasement that is coming to keep the banking system alive. The only remaining question is whether the repricing happens gradually or violently. Goldman's own model assigns a 1 in 3 probability that it happens violently, within 12 months. You are not early, you are not late, you are exactly on time. The cipher has been decoded. The market is about to catch up to the math. And when it does, the people holding physical silver will be standing on the right side of the greatest wealth transfer this generation will ever witness. This is the market cipher. If this video opened your eyes, send it to one person who still thinks silver is just a shiny rock. hit subscribe, and I will see you in the next one. The signal is clear. The noise is about to get very loud. Stay sharp.